Hey, if you are a self-employed individual who's been denied a mortgage loan, this video is for you. Oftentimes, self-employed people are getting denied because of their tax returns. So if this sounds familiar to you in your situation, I'm going to be sharing a lot of important information that you want to stay tuned for because this information may actually get you in a home quicker than you think. So what happens? Why do you get denied? And why do a lot of lenders turn away self-employed folks? Well, the most important thing that we look at for a conventional FHA or VA loan when you are self-employed is your tax returns. The benefit of being self-employed is that you can write off things. You have deductions, you have business expenses. But how do banks view this? Why does it hurt you? It's because you're reducing your taxable income when you have a lot of expenses. This is the benefit of being self-employed. You could write these things off. It reduces your taxable income. It keeps you from having to pay a lot of money to Uncle Sam. But when you want to buy a home, this is your Achilles heel. This is what really kills a lot of self-employed people when they're looking at traditional financing, whether that's conventional, FHA, VA, whatever the case may be there. So a lot of lenders only offer these specific loan programs. It really shoots you in the foot when you need a lender that has options. But what if I told you there is loan programs specific for self-employed folks, people with those high deductions? Doesn't look too good on paper, but you know you have a strong financial profile. You may have a great credit score, the money for a down payment, maybe even a large down payment, and you're still being denied for traditional financing. Allow me to introduce you to what we call non-conforming loans or non-QM loans, non-qualified mortgages. There's a lot of terms, but the most simple one is non-QM. What does a non-QM loan really kind of differ from your traditional loan? It's not sold on the secondary market. So mortgages are typically sold on the back end. It's how businesses free up their lines of credit, things like that. But when we talk about non-QM loans, they are not sold on the secondary market through Fannie Mae or Freddie Mac. Usually the institutions that are writing these loans are holding on to the loans. They're going to service your loans in a form. I like to view this as private money. So how does this get us around traditional conventional underwriting guidelines? Well, the first program I want to start with is a bank statement loan. This loan does not look at your tax returns. It does not look at anything other than, do you have a good credit score? Do you have 12 to 24 months of bank statement showing consistent deposits in there? That's what we use to calculate your income. So you don't need tax returns on a bank statement loan. What we do need is 12 to 24 months of business or personal bank statements there. So this is huge for self-employed people that have large deposits going in, but they can't show it on their tax returns, okay? Or maybe you have a lot of those deductions. So bank statement loan is the first loan there. Typically what you'll need for a bank statement loan is 10 to 20% down, depending on your credit score. Now, a lot of people get nervous because they think, bank statement loan, how's this going to impact me? Really, it is not. These interest rates have become extremely competitive, almost in line with a traditional conventional loan. So before, I used to see these where the interest rate would be higher because it was a higher risk to the bank. Now these are becoming extremely popular where they're almost in line with a traditional conventional loan. So if you are self-employed folks looking to purchase a home, bank statement loan is a great option for you. Bank statement loans can be used for primary residence, secondary residence, or even investment homes. So keep that in mind if you are a self-employed person trying to get into real estate. Again, whether that's your primary home, second home, or investment home, bank statement loan could be the option for you when conventional was not. Other thing is, if you are maybe looking at getting investment properties and you don't want to show your tax returns, we have what we call as DSCR loans, debt service coverage ratio loans. These are fantastic loans. You don't have to worry about tax returns, pay stubs, anything like that. What a DSCR loan looks at is, does the property cash flow? So does the rental income cover the mortgage payment? This is all that is needed for a DSCR loan. So we're looking at that credit score, that down payment, and that rental income. Very easy to get through. These loans, keep in mind, are dependent on that appraisal. Is it going to show that the rental income is at a fair market value, enough to cover the mortgage, is the big thing that we need to look for there. So if you're self-employed and you are tired of being told no, you want the opportunity for somebody to say yes to get you in a home, these options may be for you. If you want to explore these personally for your situation, reach out to my team and I. We would love to schedule just a 15-minute conversation for you just to see if this loan program makes sense for you and your family. Thank you so much and have a great day.